What if I wanted to create a steady monthly income stream using only 5 ETFs? Well, folks, fasten your seatbelts. This is going to be a good one. Often the goal of a retirement portfolio is to generate income. Of course, if it is tax-free TFSA generated cash, all the better. Today, we are going to put together a $102,000 portfolio of 5 income producing ETFs to see just how much tax-free income we can print from that TFSA. Now, the reason for 102,000 is that that's the total contribution room you could potentially be starting with if you were born before 1991. With a full-on income portfolio, you need to approach it with a different kind of mindset. You are not as focused on growth gains and will often forgo them to instead revel in the bigger dividends, which are going to make up, well, they're going to make up your income. You can technically create an income producing portfolio with dividend growth stocks, but it does require more maintenance and it can be impacted to a greater degree in a bear market compared to income stocks. This portfolio that we are making today will rely on covered calls and or leverage as ways to enhance the dividends and to take those yields north of 10%. It does have a higher risk level, but for the purpose of an income portfolio, the risk, well, that is part of the overall trade-off. I will also add, many income investors would even go as far as to say the risk is overrated if you are using these ETFs purely for income, but is much more warranted if you are, well, using the covered calls as part of a growth portfolio. A sub to the channel is a low-risk way to keep up to date with future content. Even though the goal with this portfolio is to generate income, I did try to get as much diversification into the mix that I could. Diversification, folks, well, it's never a bad thing. And with so many different covered call funds available now, it is much easier to do than even just a few years ago when the pickings were, well, they weren't very good. Anyway, without any further ado, let's do this. We will start with the Hamilton Enhanced U.S. Covered Call ETF. They have a ticker of HYLD. Now, this ETF, they do aim to provide attractive monthly income and long-term capital appreciation by investing in a diversified portfolio of U.S. equity covered call ETFs. The fund then will employ a modest 25% cash leverage to enhance that yield and, well, the growth potential as well. When it comes to diversification, by focusing on U.S. equities across multiple sectors, HYLD offers exposure to the U.S. market, complementing Canadian holdings and reducing home country bias. The sector allocation includes everything from technology, healthcare, and consumer discretionary to financials and, well, others. This will provide some pretty broad diversification. At the time of recording, their price was coming in at $14.19, and they have an NAV of $14.23. Their assets under management, $828.9 million. Looking at the fees, the management expense ratio on this one, 2.64%. In terms of their dividends, they do have a yield of 11.889%. That's a monthly dividend of 14.3 cents per share. When we look at their one-year return on investment, that comes in at 11.73%. Once we add in those dividends, we do get a total return of 25.02%. Now, in terms of our portfolio, we're going to add 1,425 shares of HYLD, and that's going to generate $203.78 per month. We're going to keep a tally as we move through these, so that should be pretty exciting. In regard to their dividend, in the last bear market, they did cut it by 2 cents, but it recovered that 2 cents fairly fast once the market recovered. Okay, let's move on to the Hamilton Enhanced Multi-Sector Covered Call ETF. It's got a ticker of HDIV. This one does aim to provide high monthly income and, once again, some long-term capital appreciation by investing in a diversified portfolio of Canadian equity covered call ETFs. They also utilize a 25% cash leverage to enhance that yield and return potential. When it comes to diversification, HDIV offers exposure to various Canadian sectors, aiming for a sector mix broadly similar to the S&P TSX 60. This diversification reduces concentration risk and provides balanced exposure across multiple industries within Canada. At the time of recording, their price was coming in at $17.81, and they had an NAV of $17.87. Their assets under management, 622.9 million, and that management expense ratio, 2.41%. Now, in terms of dividends, they have a yield of 11.263%. That's a monthly dividend of 17.1 cents per share. Looking at returns, that 1 year return on investment, that's coming in at 12.51%. Factor in the dividends, we get a total return of 25.18%. Now, as for that portfolio, we are going to add 1,150 shares for another $196.65 each month in income. That takes us up to $400.42. We still got three more to go, so that's gonna head up quite a bit. In regard to their dividend, in the last bear market, they did not cut at all. In fact, they increased it by 0.8 cents. So that's not too shabby. Up next, we have the Global X Enhanced Canadian Oil and Gas Equity Covered Call ETF with a ticker of ENCL. They aim to provide high monthly income and a little bit of growth by investing in a diversified portfolio of Canadian energy companies via their underlying ETF, ENCC. They also utilize a 25% cash leverage to enhance that yield and growth return potential. When it comes to diversification, ENCL gives you a solid exposure to the Canadian energy sector through, of course, that underlying ETF, ENCC. At the time of recording, their price was coming in at $18.76, and they have an NAV of $18.71. Those assets under management, 197.66 million, and that management expense ratio, 2.36%. Looking at their dividends, they have a yield of 18.373%. That's a monthly dividend of 26.5 cents per share. All right, oil took a beating last year. So that 1 year return on investment, it's down. It's negative 0.11%. But those dividends still made the total return pretty respectable because once they're added in, 18.29% total return. All right, for that portfolio we're building, we'll add 1,075 shares for $129 per month. So that does take us up to $529.42 per month. We still got two more to go. We're easily going to break 1,000. Don't worry. I will point out that this fund was not around in the last bear market, but with oil and gas struggling this year, they did cut their last dividend by 2.5 cents. Nonetheless, it is still a good dividend. Okay, moving on to our next one, we've got the Harvest Equal Weight Global Utilities Enhanced Income ETF. They got a ticker of HUTE. They aim to provide high monthly cash distributions as well as capital appreciation by employing 25% leverage and covered calls to their underlying ETF, HUTL. In terms of diversification, through that underlying ETF, they gain a lot of exposure to large cap global utility stocks with, of course, proven records of long-term cash flows. Also, keep in mind, whatever the market's doing, people still need power. At the time of recording, their price was coming in at $10.39, and they have an NAV of $10.38. Those assets under management, 29.59 million, and that management expense ratio, 2.25%. Looking at their dividend, their yield is coming in at 10.024%. That's a monthly dividend of 8.8 cents per share. On their 1 year return on investment, that's coming in at 14.05%. Add in those dividends, we do get a total return of 25.48%. And for the portfolio we're building, we're going to add 1,976 shares for $173.89 per month. That takes us up to $703.31 per month. We still got one more, though. We still got one more. This fund did begin at the end of the last bear market, so we will have to see what it does in the next one. However, the utility sector does tend to do well despite market conditions. As I said before, there is always a need for more power, for sure. Our final ETF is the Harvest Diversified High Income Shares ETF, HHIS. This ETF offers a multi-sector portfolio that captures a diverse selection of trending companies that are positioned for strong growth. They do employ 20 to 25% leverage as well as a covered call strategy to enhance that return. When it comes to diversification, by holding a full spectrum of harvest high income shares, you gain exposure to the US technology sector as well as some exposure to cryptocurrencies as well. At the time of recording, their price was coming in at $13.29, and they have an NAV of $13.31. Those assets under management, 100.61 million. We do not yet have a management expense ratio as it is a brand new ETF. When it comes to dividends, they've got a really nice looking yield of 22.573%. That's a monthly dividend of 25 cents per share. Since inception, their return on investment is coming in at 5.48%, and that total return 7.46% with the dividend they're about to pay out. Now, for the portfolio, we're going to add 1,550 shares for an additional $387.50 per month. That takes us up to $1,090.81 per month. That's really not too shabby, especially if it is in a TFSA and it is coming at you tax-free. This fund just begun, so we have no real data other than the fact that I have a lot of faith in the underlying assets. I think this is going to be a good one for sure. There are other income variations that you could have picked for these ETFs, but in general, this is a mix that I like for sure. Let me know in the comments how you would have done this differently. I am super curious to see what you'll come up with. If you are interested in the ETFs that we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on my 5 total return ETF picks. Thank you for watching, and I will see you in the next video.